if we see the legal position of the accounting concept, so it is legally accepted or it has a legal acceptance. If it is not so important to record in the books of account, such transactions have to be completely ignored. If a transaction is relating to a particular aspect, then we have to include all the transactions. There are a number of types of organization and the standard has to be applied to each and every type, so it is a difficult task. Hello everyone, I am Harshita, lecturer, Department of Commerce, Vidhyaashram First Grade College, the Temple of Excellence, Mysuru. My dear students, today we are in the 8th session of Unit 1 of the subject Financial Accounting 1, and this is for first sem BCom student, and the Unit 1 is all about Introduction to Financial Accounting. So we were learning about financial accounting and already we have learned few of the concepts, that is we were discussing about accounting concepts. So let us quickly recall what we have discussed in a previous session. So in a previous session I have covered this topic, that is we were discussing about all the accounting concepts. So as I have already told you, in accounting we cannot record the transaction as per our wish. So there are certain principles, there are certain guidelines, there are certain rules to be followed. So where accounting concept is also one of them, where we have learnt about all the accounting concept, what each and every accounting concept tells about a recording of the transactions in the books of account. In today's session, we shall continue with a new topic, that is accounting conventions. Now let us see, it is also one of the accounting principle here. So first we have learnt about accounting concepts, now we shall learn about accounting conventions. Now what is this accounting convention? An accounting convention may be defined as a custom. So it is what? It is a custom or generally accepted practice which is adopted either by the general agreement or common consent among the accountants. So based upon the opinion of the accountants, so some framework has been done in accounting, so which is known as what? Accounting conventions. So what is this accounting conventions? So it is a custom or generally accepted certain principles which is been followed while recording the transactions in the books of account, where the number of opinion or the opinion of the accountants are brought together and this conventions has been framed. So this is about the meaning of accounting conventions. Now moving on to the next topic, let us see what is the difference between accounting concepts as well as accounting conventions. So already we know the meaning of these two terms. Now we shall see what is the main difference between accounting concepts as well as accounting conventions. Now coming to the first difference, so the first one is legal position. So based on legal position, how this accounting concept is different from accounting conventions. Now coming to the accounting concept, accounting concepts have legal acceptance. So here if we see the legal position of the accounting concept, so it is legally accepted or it has a legal acceptance. Whereas accounting conventions are guidelines. So what it is? It is a guidelines based upon the custom or usage or general agreement. So depending upon the usage or depending upon the general agreement, this accounting conventions is being framed. So this is the first difference. Now coming to the second one, recording versus financial statement. So how this is different from accounting concepts and in accounting conventions. So accounting concepts are the basic assumptions. So what is accounting concept? So these are the basic assumptions or ideas which is being followed while recording the transactions in the books of account, and it has a legal acceptance. So these are the basic assumptions on the basis of which transactions are recorded and the accounts are maintained. So based on those assumptions, the transactions are recorded in the books of account. Whereas coming to the accounting conventions are followed in preparing profit and loss account as well as balance sheet. So this accounting concept is used in the stage of recording itself, whereas this accounting conventions that is used in the preparation of profit and loss account as well as balance sheet at the end of the financial year. Next, coming to the next difference, that is significance. These are the uniform set of rules usually followed in recording of the transaction. So, where do we find this accounting concept? While recording the transactions. So, these are the basic rules which are followed while recording the transactions. Whereas accounting conventions, these are not so important as accounting concepts. So, if you see the importance here, accounting concepts is more important than accounting conventions. Okay, so accounting concept is used at the stage of recording itself, and these are the basic rules to be followed. Next difference is that role of the personnel. So, there is no role of personal judgment or individual bias in terms of accounting concept. So, this personal judgment or the individual bias and following the accounting is not there in accounting concepts. Whereas coming to the accounting convention, personal judgment plays a very crucial role. So, personal judgment plays a very important role in accounting conventions, and even the personal bias is also there in the accounting convention, where it is not there in the accounting concepts. Next one is uniform adoption. There is uniform adoption of accounting concepts in different enterprise. So, here each and every organization, while recording the transactions in the books of account, they have to follow the accounting concept. But when compared to accounting convention, there is no uniformity. So, here uniformity is not been followed in the adoption of accounting conventions in various enterprise. So, it's not compulsory that each and every enterprise has to follow the accounting conventions. So, it based on the organization whether they have to follow it or not. But accounting concepts has to be followed by each and every organization. So, these are the certain difference between accounting concepts as well as accounting conventions. Now, moving on to the next concept, let us see what are the important accounting conventions. So, we have already learned there are number of accounting concepts. Now, let us learn about what are the accounting conventions. So, the first one is convention of materiality or materiality concept. So, what is this convention of materiality? So, here the word itself says that we have to record those transactions which are material in nature. So, what do you mean by material in nature? In the sense, only the important transactions has to be recorded in the books of account, or the significant transaction has to be recorded in the books of account. Immaterial transactions has to be ignored. So, this convention tells that only the material transactions or the material points that has to be included in the books of account, and the immaterial facts has to be ignored. So, it means that in accounting, a detailed record is made only of those transactions which are material, that is significant to the users of accounting information. So, whatever the information which are needed by the users, so based on that, only the important information or only the significant information has to be recorded in the books of account. No detailed record is made of transactions which are not material or insignificant in nature. So, if it is not so important to record in the books of account, such transactions have to be completely ignored. So, depending upon the user's demand, we have to record the transaction, and that has to be communicated to the users. So, insignificant. So, there are number of transactions that takes place daily. It's not that all the transactions are material in nature. So, there are certain transactions which are immaterial in nature. So, such type of transactions has to be ignored. For example, according to Materiality Convention, when a pen worth rupees 20 is being purchased, so we are going to record rupees 20 only. Why? Whether it is used or not. So, it is not that important, but we are going to record the amount what we have purchased that pen. So, according to the Materiality Convention, when a pen worth rupees 20 is put to use, the entire amount of rupees 20 is treated as an expense. So, we cannot tell that only half I have used and half cannot be recorded. So, the whole 20 rupees has to be recorded as an expense immediately, though the pen is used for few days, whether we use or not. But we have to record the expense which is incurred on that particular pen. So, this is convention of materiality. Now coming to the second one, convention of conservatism or convention or conservatism concept. Now let us see what is this convention of conservatism. So it means in accounting records and in the financial statement of a business, all prospective losses should be considered. So what are the possible losses that we are going to overcome in the future? So those transactions have to be recorded. That is, all the prospective losses should be considered and provided for, but prospective profit should be ignored. So what we are going to do, whatever the possible losses that we are going to overcome in the future, so those possible losses have to be recorded or given importance, and the prospective profit, what we are going to earn in the future, so that has to be ignored. In the sense, be prepared for the worst year. So whatever the losses that we have to overcome in the future, if we know about it, so be prepared for that. So that's what this convention tells us, that is convention of conservatism. In short, according to this convention, provide for all possible losses but anticipate no profit. So don't expect the profit, but make sure that you are prepared for all the losses. So when suddenly a bulk of loss has been incurred, so your organization should be able to recover that loss. So be prepared for the anticipated losses and ignore the anticipated profit. So valuing closing stock at cost or market price, whichever is lower. So here we are going to consider whichever is lower, because we are going to possibly estimate what would be the future loss. Creating provision for doubtful debts. So we have heard about it. So suppose if any creditors have not paid the amount, so we are going to make a provision for that particular debt as provision for doubtful debts, and some of the examples of application of the principle of conservatism. So these are the best example where we are going to make ourselves safe. That is known as what? Convention of conservatism. That is, always be prepared for the losses. Next one is convention of consistency or consistency concept. So here the word itself says that consistency means what? Same. So similar. So whenever we are going to follow a particular method in one particular year, so that method has to be followed throughoutly. So because anyhow we are going to compare the financial result at the end of the financial year. So if you are following different methods, then different results will be obtained. So it is difficult for the comparison of financial results. So this convention of consistency tells that, so if the organization is following a particular method to calculate the profitability of the business, then follow the same method throughout the year. Okay, so don't make changes in any of the methods, because if you keep on changing the methods, then the result what we get will not be accurate and the comparison is not possible. So it means that accounting policies and practices should remain consistent. So whatever the accounting policies or the practices what the organization is going to follow, so it should be consistent in nature. That is, uniform or unchanged from one accounting year to another year. So from one accounting year to another year, whatever the organization is going to follow the principles and practice, so that has to be same. So if we are not going to follow that, then the comparison will be difficult. So example, when once a particular method of depreciation, so there are written down value method as well as straight line method to calculate the depreciation. So if I am following the written down value method, then I have to continue with written down value method only. So depreciation is adopted for a particular fixed asset. The same method should be followed for that asset year after year. So we have to follow the same method year after year. According to Indian accounting standard, consistency is a fundamental assumption. So consistency, this convention of consistency tells that if we are going to follow a particular method, then continue the same method year after year. So this convention enables a meaningful comparison. So the main intention I have already told you, that is in order to compare the results. So if the methods are different, then the comparison is highly impossible. So make sure that you follow a similar method or the same type of method where the comparison of the results will be easier. So this is about comparison will happen year after year. So this is about convention of consistency. Next one is convention of full disclosure. So here also the word itself says that full disclosure. In the sense, if a transaction is relating to a particular aspect, then we have to include all the transactions. So all the important items has to be included in order to ascertain the correct profit or loss of the organization. So, or we also call it as full disclosure concept. So it means that all material facts. So here also you have to remember, if they have told that we have to include all the facts, so it doesn't mean that we are going to include the immaterial facts also. So all the material facts has to be included and make sure that nothing is been ignored. So it means that all material facts relating to accounts must be disclosed in the financial statement with sufficient details. So with proper information with proper details, all the material facts has to be included while preparing the financial statement at the end of the financial year. Example, in case of sundry debtors, not only the total amount of sundry debtors should be disclosed, but also the amount of good as well as secure debtors. So it's not just that only the amount of sundry debtors we are going to take into consideration. So other than that, if there are secure debtors, we have to take into account. Or if there is any provision, so those provisions should also be considered while taking the amount of debtors, and the amount of doubtful debts should be mentioned. So if there is doubtful debt also, we have to mention in the asset side of the balance sheet. The idea behind this convention is to enable the users of the financial statement to make proper decisions. So if the financial statements are correct, then only we can make the proper decisions. So if something is ignored or some material facts is been ignored, then of course it affects the accuracy of the financial results, and then thereby we cannot take the appropriate decisions. The practice of giving notes related to various facts or items which do not find place in accounting statement is according to this convention. So here what you have to remember here, accounting or the convention of full disclosure tells that whatever the material facts which is being used to prepare the financial statement, we have to include all that material facts. So nothing can be ignored. So if we ignore, then it will affect the accuracy of the financial statement, thereby decision making will also become difficult. So these are the important accounting conventions. So we have learnt about all the accounting conventions. Now moving on to the next concept, that is accounting standards. Now let us see what is this accounting standard. Of course, we know in order to make the comparison, there should be uniformity in the accounting information which is being provided to the users. So in this particular unit, you are going to learn about accounting principles, concepts, conventions and all the theoretical aspect about financial accounting. So let us see, this is also one of the important theory here, that is accounting standard. Now let us see what is this accounting standard. So accounting standard can be any form of statement which consists of rules and guidelines. So what does it contain? It contains all the rules and guidelines issued by the accounting institutions for the preparation of uniform and consistent financial statement. In order to maintain the uniformity in the accounting system, so these are the standards. So standards includes rules as well as guidelines that has been followed by the accountant while recording the transaction. The main intention is to bring uniformity as well as consistency in the accounting information of the organization. Accounting standard is an authoritative statement issued by ICAI, that is Institute of Chartered Accountant of India. So this accounting standard is being issued by ICAI, that is Institute of Chartered Accountant of India, a professional body of accounting in a country. So here accounting standard is issued by whom? ICAI. The objective of accounting standard is to bring uniformity. So as I have already told you, the main intention is to bring uniformity in different accounting policies in order to eliminate non-comparability of financial statement for enhancing the reliability of the financial statements. So, if each and every organizations are following the similar type of accounting policies, accounting procedures and accounting standards, so what happens? There will be a uniformity in the financial statement. So, thereby easy comparison from one organization to another and from one year to another is possible. So, this accounting standard has been issued by ICAI. Secondly, the accounting standard provides a set of standard, that is accounting policies or guidelines, or even we call it as accounting rules, valuation norms and disclosure requirements. So, this is about the accounting standards. Now, let us see what is the need for accounting standard. So, the first one is accounting extends information to various users of information. So, what happens if the accuracy, so if the organization is following all the accounting standard and if it is preparing the financial statement at the end of the financial year, then whatever the information which is being communicated to the users, so there will be accurate, so that the users can rely on the accounting information which is provided by the organization. So, accounting extends information to various users. So, the main intention is to communicate to the users. Next one is accounting information can serve the interest of different users only if it possesses uniformity and full disclosure of relevant information. So, when the user is going to depend on the accounting information, when the user feels that whatever the information which is being provided by the organization is accurate and it is uniform, at the same time it is relevant in nature. So, if it is relevant in nature or it is uniformity in nature, then only the user will depend upon the accounting information. Next one, there can be alternate accounting treatment and valuation norms which may be used by the business entity. So, by using this accounting standard, there may be any alternate accounting treatment. So, that can also be identified by the accounting standards. Next, accounting standard facilitate the scope of those alternatives which fulfill the basic qualitative characteristics of true and fair financial statement. Of course, a systematic standard is being followed while recording each and every transactions. Thereby, the accuracy can also be maintained and the standard of accounting information will also be more. So, a true and fair financial statement can be produced to the users. So, these are the need for accounting standards. Now, coming to the next one, that is benefit of accounting standards. So, accounting extends information to various users of information. So, as I told you, it helps in extending the information to various types of users. So, here the need itself can become the benefits of this accounting standard. Next, we have learnt about it serves the interest of different users, only it possesses the accurate results. So, it helps to fulfill the need of different types of users, and there can be alternate accounting treatment and valuation norms. So, based on the accounting standards, we will be able to come to know what are the alternate accounting standards that can be followed. And the next benefit is that if the accounting standards is being followed, we'll come to know what are the qualitative characteristics of the financial statement by seeing through this accounting standards. So, here the need itself can become the benefit of accounting standards. Now, coming to the limitations, so there are also certain limitations for accounting standard. So, the first one is accounting standard make choice between different alternative accounting treatment difficult to apply. So, here the accounting standards is not an easy task because each and every accounting standards has to be applied for each and every type of organization. So, there are a number of types of organization and the standard has to be applied to each and every type. So, it is a difficult task. Next one is it is rigidly followed and fails to extend flexibility in the applying of accounting standard. So, here flexibility is very less in accounting standard because in accounting standard those principles are set in advance where the organizations have to follow that. So, depending upon the organization type, we cannot change the accounting standard. So, it is very rigid in nature and it lacks flexibility. Accounting standard cannot override the statute. The standards are required to be framed within the ambit of prevailing status. So, as I told you, it is decided in advance where the number of accountants have come together and it has been decided in advance. So, each and every organizations, so rigidly they have to follow these accounting standards. So, it is less flexible as I have already told you, and no one can overcome these accounting standards. So, they have to follow that. So, these are the certain limitations of accounting standards. Now, what are the applications of accounting standards? So, where does these accounting standards are being applied? So, except the purely charitable organization which does not have any commercial, industrial and business activity, accounting standard is applicable too. Now, so for a purely charitable organization where their intention is not to earn profit and they do not indulge in business activity, for such organization this accounting standard is not applicable. Other than that, here there are certain list of organization where this accounting standard is being applied. So, the first one is sole proprietorship unit where there will be a single owner. So, sole trader is nothing but what? It is a single owner business. So, this accounting standard is applied for sole proprietorship. Then partnership firm, it is also applied for partnership firm. Then societies, trust, Hindu undivided family, association of persons and cooperative societies, companies, etc. So, there are number of organizations where except for purely charitable organization, then for all other organization, this accounting standard is applicable. So, this is about the applicability of accounting standard. Now, coming to the next session. So, let us see what are the topics that we are going to discuss in the next session. That is, we shall learn about difference between IFRS and Indian accounting standard. So, let us see what are the main difference between IFRS and Indian accounting standard, and we shall learn about few of the concepts relating to accounting standards. So, we shall see what are the accounting standards. So, we shall discuss only few of the accounting standards in my next session. So, my dear students, hope you have understood today's session. See you all in my next session with a new topic. Till then, take care. Thank you.